So we'd like to thank everybody for joining us today. Again, the topic or the concept of these Mooney Talks Money podcast is to bring the people that we rely on to help be good stewards of your money in front of you and kind of so you guys can see the advice that we're getting inside there. And we're lucky today we have Adam Seuss with us. He's a partner and portfolio manager at Yacktman Funds. Also, I found this out that you created a blog back in the day called Value Uncovered, which is pretty good to kind of go back and look over and read some of that too. So, Adam, why don't you start out by doing like a brief overview of yourself and the Yacktman, why you left your blog that you created to start a whole new career in portfolio management.
Yeah, sure. And Joe, thanks for having me. So as you said, I'm one of the partners and portfolio managers at Yacktman Asset Management. I actually joined the firm 10 and a half years ago now, which is it's hard to believe. Straight out of an MBA program at UNC Kenan-Flagler. And as you stated in the intro, I actually did get the job though at Yacktman, not necessarily through the MBA program, but because of the blog. I've been writing about investments online. That was partly the reason that I went to business school, and one of our partners here stumbled across the blog and just sent me an email out of the blue. And so here I find myself, over 10 years later. And I joined a firm. I mean, Yacktman itself is very much a boutique asset manager. We now have a 30 plus year track record of focusing on risk adjusted returns over time. The firm is very value oriented. We care a lot about price, and we also focus a lot on risk management and downside protection. So we think of ourselves as business owners. It's a small, close-knit team that's been working together for a very long time. Everybody at the firm is a generalist. Everybody's responsible for idea generation. And the goal of it, for our clients and end customers is we end up putting together what we think is a rather unique portfolio that looks quite a bit different than the index. I guess that, in industry terms, it would be kind of high active share if you want to use the industry terminology. But basically what we're trying to do is use flexibility and be different enough to invest, to go out and find the best risk-adjusted returns we can for our clients. And we've been doing it for 30 years, and the hope is to continue doing that.
That's awesome. Oh, it's a good background too. So when you kind of look out there, there's probably some common misconceptions that you see that investors have. So if you're kind of talking to that investor and they're looking over the investment landscape and these common misconceptions that they have, how would you say they should address or navigate through some of those kind of common misconceptions that you've seen over your career?
Well, I think, I would say maybe working with a trusted advisor is always a good first step. So I'll throw that plug in there. But I mean, there's a lot of misconceptions with investing. I think, just it goes against some very basic parts of human nature if you think about it. But when you're actually talking about investors, there's a lot of different ways to do it. And I think, one misconception, everybody likes to focus on finding the great business or maybe the great product in their personal life. And especially in this environment or the environment in the last 10 years or so, some investors sort of forget to think about the price that they're actually paying for that great business. I mean, everybody knows that a Visa or a MasterCard is an amazing business. But for us at Yacktman, a key part of value investing, at least as we define it, is finding opportunities where you're getting something without really paying much for it. And maybe it is because it's an amazing business, but it just is priced like an average one. Or maybe it's only an average business, but you're just getting it at, it's priced like it's going to go out of business, tomorrow. But price matters a lot. And I mean, you only have to look at, a company like Microsoft. We've owned it here at Yacktman for probably 20 plus years now when we first bought it at various weightings in the different portfolios. But if you bought Microsoft in 99 or 2000, the stock price went nowhere for a decade. And that's despite really great business performance. I mean, if you look at Microsoft's financial results over that decade, revenue grew, earnings grew strongly, they threw off tons of cash. But I think it just illustrates it's important to separate the underlying business from the stock price. And valuation does have a big impact, even if the business performance is actually decent. I think you see a lot of stock pitches out there. This stock trades at, at a 12 PE, and, we're hoping to sell it to somebody for a 20 PE later. And I think that's important to be aware of, but you also need to make sure, and really where we start at Yacktman is we need to be comfortable with the cash flow that the business produces, getting back to that business owner mindset. And if we can get an acceptable rate of return from business performance, and then we get some upside by the multiple expanding over time, that's just pure upside. But price does matter a great deal. I think it helps with downside protection and risk management overall in the portfolio. But sometimes people just focus on trying to find the very best business, not necessarily find the very best, risk adjusted return.
Gotcha. That kind of leads into the next topic. I think you covered a little bit on it, but maybe we can expand a little bit more. It is risk management, which is a kind of a critical aspect of investing. But when you look at your company or your approach in regards to assessing risk mitigation and risk mitigation strategies, can you expand a little bit on that? I know you touched a little bit already.
Mm-hmm.
You can expand a little bit more on that.
Well, everybody loves to talk about the return side of the equation, right? I mean, that's kind of where everybody focuses. What kind of returns can I expect? How what's the end result going to be for my retirement portfolio if I get these kind of returns? And so there's a lot of focus on returns, 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 returns. But Yacktman's been known through our 30-year history that there's an other side of the equation, and that's the risk that you're taking to get those returns. I mean, hopefully your clients will know and understand the math of compounding, but even really long-term track records at high returns, they get interrupted really quick if you have a zero in there somewhere in the middle. And there's investors out there that look amazing for a bunch of years, but it could just be because they're ignoring very large risks in the portfolio or in the companies that they're investing in or the valuations they're investing in those companies. And they can skate by for a while, but eventually those risks come back to bite them. And so when we're we're looking at our investments, we're trying to understand what is the range of possible outcomes. We want to make sure that we're covered on the downside first because we're not going to get everything right. And we're actually open to investing in some companies that offer more modest rates of return, but with much lower risk than the market. They can be just as value added in the portfolio. I mean, it's almost like a bond manager, right? If you can invest in a AAA bond, and I guess there's not very many of those out there anymore, but there's a AAA bond out there, your rate of return expectations for that AAA bond wouldn't be nearly as high as if you invested in some, triple C somewhere. Like obviously you're taking a lot more risk investing in that triple C, and you should get a higher rate of return. But it could, that AAA could be a very steady part of the portfolio. And so we try to manage risk by not paying too much first and foremost, but also building a portfolio that's resilient to a wide range of potential outcomes. I think there's some firms and some investors that try to predict the future and say, like, we're going to do all this research and this is going to be the path. We like to say we're not exactly sure how the future is going to unfold, but we want a portfolio that can handle lots of different variations. And so if you focus on risk, you end up with a resilient portfolio. And then what that really allows you to do is play offense when other firms are playing defense. So if it's a year, 2022 or March of 2020 or 2008, 2009, having the ability to pick up those key bargains when everyone else is sort of panicking and playing defense is a big part of long-term performance in our view.
That's awesome. I love how you use the triple C analogy because I'm going to use that to pivot to the next topic, emerging markets. Regards to their big risk or big return, right? There's a lot of opportunities in emerging markets, but also probably a heightened sense of risk. As an investor looks at possibly investing in the emerging economies, what are some of the things they should be thinking about or be concerned about as they look over there?
Well, I think whether you're investing in your, the domestic market or your home country or outside of it, it starts in the same place. But there are new challenges with investing in, countries outside. You don't have some of the local knowledge or on the ground knowledge that maybe others might have. And if you gave me a US stock and then an emerging market stock, and they offered the very same price and the very same return potential, then you'd obviously lean towards the domestic stock because you're not taking all those extra risks, right? So I think it really boils down to, are we paying a cheap enough price to be compensated for some of those extra risks? And now there's some emerging markets out there that are just frankly difficult to invest in. Uh, Rule of law isn't always there, and maybe the companies aren't necessarily working for owners or shareholders, but for other constituents. The government being one example, and so it's hard to call that investing, right? If you don't have that assurance. But even if you look at the emerging market index, and frankly, we don't pay that much attention to what's in the index, right? We try to just find the best opportunities that we can. But one of the top countries in there is South Korea. You could probably argue that's misclassified. I mean, there's a long history behind the reasons why, but if you've ever been there, which I have, I mean, it's a well-developed country. GDP is high. I mean, they've grown some world-class businesses and brands. You think of Samsung or Hyundai. I mean, but it's still classified as an emerging market. And there are unbelievably cheap companies in Korea, especially on the smaller cap side, good businesses trading at, single-digit multiples of earnings, tons of extra cash on the balance sheet. And the government there is moving to reform their market, to open it up to outside investors, and corporate governance is slowly but steadily improving. So, for us, if you could look at something like that and say, well, this is an emerging market by index, and maybe that disqualifies it for some investors. But if you can find one like that where people are ignoring it for some classification reason, but you can get a similar level of risk, but much cheaper valuations. That's sort of how we approach it versus, we have to invest in emerging markets. It's all dependent on the market and the opportunity, but we're constantly looking for things that are a little bit different than just the high level or initial reading that you might do on a subject.
I love that. That kind of leads into what the last topic I kind of want to hit here on it. And I love how you explain that. So, which was awesome. So I guess in the last topic, I'm going to kind of make it broad-ish, but the old added conversation in regards to active versus passive. And then I'm going to put a little twist because I happen to read your blog, value versus growth, type scenario.
Hmm.
You're looking at that, in different pockets of time, we'll hear more people say, hey, I should have more active versus passive or passive versus active or value versus growth. Can you kind of just touch your thoughts on that? And I know reading your blog in regards to the value approach, which was awesome.
Hmm.
And I also like how you reflected back from when you started to where your philosophy changed over the years and reflecting back on that too. So you can just touch on that old adage, active versus passive, value versus growth.
Yeah, sure. And obviously, if you look back, over 10 plus years and say, what was I thinking at the time? I mean, that's you're constantly dealing with that as an investor, but the goal is to look forward and make the best possible, decisions that you can make going forward. I'll take them in the reverse order. The value versus growth. It's a little bit of a, everybody loves to classify things. Everybody loves to put things in a box and say, well, you said you're going to be, this, and so stay within your box. And sometimes we look at that and say, but what happens if the correct answer is you shouldn't own anything in that box at this particular point in time? And so we think flexibility is one of the biggest advantages you can have as an investor and as a manager, to be willing to take a step back and say, where are the best opportunities? And, we consider growth very much so in our valuation. The multiple that I'd pay for a business that isn't growing or is shrinking is a lot lower than a business that is growing strongly. But it all for us always comes down to the price and how assured we are of that growth. And growth investors, at least as Morningstar may classify it, have been on an incredible run over this last 10 years or so. Now that tends to go in very long waves. They can last 5 or 10 years over time. If you look back on kind of the past 100 plus years of financial history. But the core tenets of what we do, you could look at some of the companies in our portfolio and they don't trade at a PE multiples of 10 or 12, but we very firmly think they're value investments and partly because they may have a strong growth profile from where they're at. When you come to the active versus passive, the core tenets of the passive approach, I think, make sense. It's hard to argue with. You should dollar cost average, and you should hold for the very long term, and you should keep costs low. I mean, it's hard to argue with any of that for the average investor, but you do need active management to set prices, right? You can't have a 100% passive market. And if you have too much passive, it can create distortions in the market. And that opens up opportunities for an active manager like Yacktman. If you think about the passive index, the more prices go up, the more passive wants to buy it. We scratch our head a bit at that, right? All else equal, higher price means lower returns or more risks. But the more distortions there are, it's a better environment to take advantage and pick up bargains. So it's great for us in that sense. Uh, I think the question that clients need to ask or advisors need to talk to clients about is that as passive has grown over the last 10 or 20 years, it becomes a little bit of an all-in one-way bet on a trade that is probably the most overcrowded trade out there because everybody continues to pile into the same stocks and continues to purchase without any regard for risk or valuation. And so you ask your question of, well, for some portion of your portfolio, do you want to set aside to do something different? Now, there's a whole group of active investors that, frankly, are pretty closely tied to the benchmark and are charging high fees, and they should go away. You should consider an active approach. So, if you're going to be active, it's our view that you need to be truly active, or at least hire a truly active manager who needs to have a different portfolio in order to get differentiated results. And there isn't, a lot of us left, at least in the value space. And so our hope is we're going to be very well positioned, if and when things turn and we get a bit more of a tailwind, or at least not a massive headwind. But I think we'll try to take advantage of, the passive indexing and the distortions that they cause in the market. And, just would encourage investors to consider, do they want to be, it goes back to my earlier example. Do you want to try to predict the future and bet everything on one result, or do you want to have a portfolio that's resilient through many different scenarios of the world? And that's really what we've done, what we're trying to do here at Yacktman.
That's awesome. Thank you again. Again, I'd like to thank you for joining us today. It was awesome. It was a good presentation, and thank you so much.
All right, thanks, Joe. Thanks for having me.
Thank you.